I want to thank everyone for being here. We gave everyone a few minutes to get settled and get set up. Today is part three of our four-part series all around the different parts of investing and the different parts of saving. So today is all about the investment side of this. So with that being said, let's get started. Cool. So for those of you who haven't been on a call with me before or workshop with me before, I'm Chris Price. I'm one of our certified financial planners. And it's really my job to provide the education that allows us all to kind of have the financial knowledge to grow. So today is really about investments. What we're going to talk about is we're going to understand the basics of investments. We're going to explore different types of investments. We're going to look at what investments might make sense to you. We're also going to align our investment options with the goals and values that you do have. Cool. So before we invest, there are some things we have to be aware of. There are some things that we have to understand. The first one is be realistic with your expectations. For all of you who have sat down with me before, been part of workshops before, you know that I might have asked you, what do you expect to return, or what do you expect this account to do for you? Because investments need to have some kind of expectation. We need to understand expectations, and you need to understand expectations of what that account can do. Right? Can you be invested in something very conservative and expect to make 15%? Or vice versa, if you're in something aggressive, should you expect consistent returns? The answers are probably no, right? We have to be realistic with what we want out of it and our risk expectations. Next one, understand your comfort level with risk. I kind of just started talking about that when we have to understand that with risk, yes, may come reward, but also comes a lot of volatility, a lot of ups and downs, risk in that money we're putting up. And then being knowledgeable about investing. Right? The more we're knowledgeable about investing, the more comfortable we'll feel, the better decisions we would make. So I hope everyone on this call is going to take this time, take this information to become a little bit more knowledgeable on investing. So one of the things that everyone on this call has probably heard is the power of compounding interest. I was once told when I first started my career, and I got to double check and see if this is accurate, but Einstein used to say that compound interest is the most powerful force in the universe. And really, we can see an illustration here. So here we see two individuals, one's 25, one's 35. They decide they want to start saving in an investment account that's earning them 8% a year. The 25-year-old puts $15 a week in for the 42 years left to get to age 76. The 35-year-old puts double that, $30 in for the remainder 32 years that they have until they get to retirement. So the 25-year-old ends up putting a total of $32,760, where the 35-year-old ends up putting $49,920. So if we look at that, we can see that the 35-year-old put in a significant more, about 150% more money than the 25-year-old. But what the 25-year-old had is time on their side. So that extra 10 years actually made them net more money than the 35-year-old. They ended up, or the 25-year-old ended up with $277,641, where the 35-year-old one ended up with $247,202. So when we are looking about investing, understand it's time in the market, not timing the market. And it's better to start today with a smaller amount than tomorrow with a larger. So just keep that in mind when it comes to investing. Is a good time to invest is usually earlier than later. One of the other subjects I always bring up, and this is one of those rules that makes us financial advisors seem like we're really, really intelligent when it comes to investing. And this is called the rule of 72. This is a quick way for us to determine how long would it take money to double if at a certain interest rate. So we could see an example here. We could take 72 divided by an interest rate, 6%, and we get 12 years to double. So that means that if it was 72 by 10%, right, we were making 10% a year, it should take us about 7.2 years to double. So if you ever want to know, if you ever look at your portfolio and say, hey, I want this to double, and you ever think, hey, I want it in this many years, we can find out what rate of return we need to make to get it to double in that many years. Or if we know the rate of return we're making, we can understand how long it would take that money we have to double. So it's a quick little rule you can use to find out what your investments are going to become based on the interest rate that they're making. Now, I know everybody on this call knew I was going to talk about risk because it's definitely the biggest subject when it comes to investing. So let's understand risk a little bit. Now, there are two sides of the risk tolerance scale. The first one is the ability. The second one is the willingness. So let's break down the ability first. Basically, what this means is what's your ability to take on risk? And factors that play into here are things like income, your current savings, where you are in your lifestyle. And let's kind of break those down. Income, if your income is consistent and maybe contractually obligated, you're okay taking more risk and having those ups and downs in the market because you know you have a consistent income that's coming. Savings. If you have a lot of money in your savings account, then again, you could probably take on more risk because God forbid something happens, you could pull from your savings. Now, vice versa, if you didn't have a lot in your savings, maybe you couldn't take as much risk on your investments. And then life stage. Everyone on this call has heard the analogy, oh, when you're young, invest more aggressive. When you're older, you have to be more conservative. And that is literally what's on that life stages. The younger you are, the more aggressive you can be. The older you are, the less aggressive. And it's not so much as an age, but time to use that money. If you're 20 and you don't plan to use that money till you're 60, you have a long time. If you're 40 and you plan to use that money in your 60s, you have a lot less time. And then your next one is going to be your willingness. So willingness is something that you have to feel and be wanting to do when it comes to risk. Are you comfortable with risk? And this is not just on the investment world, this is across the spectrum. Are you someone who's comfortable taking risk? Next one, financial know-how. So the more we know about investing or the more we know about any subject, usually the more comfortable we may feel with that. And that's maybe because we understand where the hidden secrets are, or we may know where the pitfalls are. We may know where these things are. We know how to avoid them. And then personality, right? Everybody knows that risky person. Everyone knows that person is more aggressive. Personality does play a huge role when it comes to investing. So when it comes to risk, you should ask yourself some of these questions. You should ask yourself, like, what's your investment experience? Are you someone who does that a lot on your own? Maybe you've just saved a lot in your 401k, but weren't really involved, right? What's your investment experience? Next question you could ask yourself, are you more concerned with your investments losing value than excited about the gain in value? Meaning, if you lost $10 in your investments, is that going to hurt you more than if you gained $10 in your investments? Next question. If my investments decline by 30%, what would you do? Now, 30% is a huge number. So it's trying to get you to think about what would happen, what would you need to do if markets were to go down that much or your investments were to go down that much? Would you be okay? Would you pull all that money out? What would be the solution you would solve? Would you ride it out? Depending on how that answer is answered depends on maybe your willingness to take that risk. And where would you be most comfortable placing your risk tolerance? Now, this is something that if anyone has a question on what they think their risk tolerance should be, reach out to us. We'll send a little worksheet that has questions that can be answered, and it will tell you kind of where on that risk scale that you fall. It will ask you many questions like these three previous ones. All right, risk level and asset classes. Now, what does this mean? We all look at maybe our 401k. We all look at maybe our investment account. We see what they call asset classes. We see things like cash or cash equivalences. We see things called a fixed income, large cap stocks, emerging stocks, small cap stocks. These are different kinds or areas of investments. Now, for those of you that were part of our investment conversation a few months ago, we touched in depth these different sections, what they meant, what they were. So we're not going to touch too much on that, but we will explain where they are in the risk scale. So we could see on our screen right now, we could see conservative on the left-hand side all the way to aggressive. And now it's telling you where do these asset class usually place in that conservative to aggressive risk scale. Now, I will tell you, everyone on this call should have a combination of these kinds of investments, not being one single one, but you do want to ask yourself, where on this conversion aggressive scale do you want to be? Okay. So kind of transitioning out of risk and risk tolerance. This is a slide that I find super important because I get this question a lot. So for those of you who really want to understand how your investments are kind of structured, this is a super important slide for you. We went over asset classes, but let's go over the next two sections on this. You see the word vehicle and you see the word account. Now, I know that vehicle has a picture of a car. It's just to show it's a vehicle. It has nothing to do with cars that you drive or vehicles like that. Vehicle, basically what it means is the engine that's driving the investment performance or the lack of performance. So we see the list there: hard assets, stocks, bonds, mutual funds, ETFs. These are the investments that you have. And if we look on the right of your screen, your account, these are the accounts these investments are in. Why this is important is because I can't tell you how many times I've had conversations and people have asked me, and it's a great question to ask. They've asked, well, how much do I make if I had a traditional IRA, or if I had a Roth IRA, or how much do I make if I had a 401k? Well, mind you, those accounts aren't what makes you money. Those are just the accounts that the vehicle is being held in. So the vehicle is what makes you the money. The account is where it's being held. So just kind of keep that in mind. You could have the same vehicle in a 401k or in a brokerage account, and they're going to perform the same. Account, vehicle. All righty. Now let's get some little interesting fun, let's get some interesting points of this conversation. These are some common investment strategies. So what you're going to see is you're going to see investment strategies that we may use, we've seen others use. These are just some of the common ones. We're not going to go in depth in investment strategies. That's beyond the scope of this class, but we will talk about some of those common investment strategies. So what's the importance of having a strategy? Well, there's a million different ones, but let's break it down to these three. Create structure, which provides a lot of confidence when markets are doing things that are short term. Prevents reactive investing. I speak to people all the time, and I can promise you that one person a day at least is going to call me and say, we should do this because all these things are happening. Right? We should buy something because the markets are going up, or we should sell something because the market's going down. Well, although that might be something we should do, we're not going to do it just because that's how we felt on that day. When we have a strategy, we won't have to act reactive. And then at the end, the last one is it reinforces time in the market. If we have a plan, we know how long we're going to be, we know how long it should be invested, and we're going to execute in that manner. So let's talk about some of these investment strategies. First two that we're going to talk about are probably the most common people here: active versus passive. And it doesn't have to work independent of each other, but active versus passive. What's the active's goal? The active's goal is to outperform the market. Now, let me take a step back and answer this question, because this is something that my industry uses a lot. We use the term the market. But if you were to Google the market, what is that? What is actually the market? When we talk about the market, we typically talk about one of two things: either a benchmark to the risk tolerance of the portfolio, or the S&P 500. The S&P 500 is the 500 biggest companies in the United States, and it's really used to determine how markets are done when we speak in general terms, or when you hear the news talk about it, or something like that. But anyhow, back to this. Active, it's designed to outperform the market. Generally speaking, there's a higher cost for these investments, right? There's more activity, there's more things done, there's more time needed to take. Their goal is looking to outperform the market by using market timing, by taking things out when things are not good, putting things in when things are good, to put them in. So where the markets kind of go like this, they want to buy and sell at the right time to increase the return of your portfolio. And they're looking to identify misplaced assets. This is assets that should be worth more than you can buy them for. On the other side, passive. Their goal is not to beat the market, it's to mirror the market, to be like the market. Because there's none of that ins and outs and actually trading needed done, their cost should be a lot less. And because that happened, they also have a lot less complexity. You should know what you're in when you have a passive investment. It is the S&P 500 or the Russell 2000 or the Dow Jones or whatever it's mirroring. And then it often involves broad market index funds, as you might know. S&P 500 fund, Dow Jones fund, things of that nature. Another strategy is diversification versus asset allocation. Now, we hear diversification all the time, because diversification is more than just this topic that I'm talking about right now. Diversification basically means don't put all your eggs in one basket. So although we're using the term diversification, I don't want you to think that it supersedes all that other diversification we talk about. What this is saying is you're going to be invested across the market, throughout the market, in different areas throughout the market. And what you're trying to do is you're seeking protection against areas where the market is not doing well. Meaning if you're in all the areas and one's not doing well, you still have some protection. Some characteristics. It mixes markets that expand many categories, as we just talked about. It trades short-term returns potentially for risk management, meaning we're not looking at how things are doing in the short term and some of the returns we could get there, but we're going to invest expecting that our risk tolerance will get us to the goal that we want. Helps protect against unsystematic risk events, which basically is what I'm saying. Risk that is not market driven is in certain areas. Next one, the other side, is asset allocation. Now, asset allocation is seeking investments based on someone's goal, risk tolerance, and time horizon. Basically, it's saying what area should someone be invested based on how much time they have left, right? What risk they should be, what their risk profile is, what their goals are. Another area is tax diversification. If you ever sat down with me, you know that we've always talked about, hey, how much should you have in your Roth? Should you have in your traditional? Should you have outside? Should you change? Should you have all in one? Should you have a combination? Right? Trying to say, okay, well, we want to make sure that it's about the dollar we receive, not the dollar we have. So how can we be efficient through taxes? And then last but not least, we have dollar cost averaging. Dollar cost averaging is the most common way you invest in your 401k. It's investing over time. It's giving the same dollar amount in the same period. So you're buying the ups and you're buying the downs. You're buying the ups, you're buying the downs. And it's basically systematically investing to avoid market timing, right? And avoid putting a large amount in at a bad time. So those are all the strategies we're going to talk about today. I will tell you, it's not a pick one and don't do the other. If we look at the different strategies we talked about, like active versus passive, most portfolios have a combination. They have some active investments, they have some passive investments. If we looked at diversification and asset allocation, yeah, we should be diversified, as I spoke about earlier, in all our accounts. The asset allocation basically says, where is our diversification going to be? And obviously, tax diversification is super important, and we should always constantly be investing in the market. So all these strategies are something we could do as a combined, not just a single unit. Now, let's put it all together. Let's build on the knowledge we have. Let's set benchmarks to measure our success, to maybe use the rule of 72 to find out, okay, am I hitting that metric to double that money at the time period I want? And develop a strategy and stick to it. So I want to thank everyone for being part of this workshop. The first one we did in this series was foundations. The second one was spending and savings. This one was investing. Next month in November, which will be our last one for the year, is going to be retirement. I want to thank everyone for taking their time. If you have any questions for me, you could use the QR code on your screen to go ahead and find out to ask me those questions. You can also find a time on my calendar if you want to schedule some time to talk. I hope everyone has an amazing day, and I'll see you next month.